All right. Hello, everyone, and welcome to Real Talk with Diane and
And
Bruce.
Bruce,
We are in the same house tonight in two different rooms just because of our crazy setup tonight, and my dog's knocking on the door. This is what happens. We have technical difficulties like every night that we do this. We're in week 7, and you'll have to excuse me. I have to open up the door because the dog is banging at the door. All right, I'm going to ignore him. Anyways,
he's
um,
sitting now.
what was that?
He's sitting at the door now.
He is sitting at the door, so let's hope he stays that way. So thanks everyone for joining tonight. As we talked about earlier, and we posted, we do have a special guest tonight that we'll get to momentarily. Doug Koval is a CPA. He's actually our CPA, and he's phenomenal. And he's going to talk to us about capital gains taxes. Basically, it's funny. I never really thought of it much in the past markets because there's a pretty hefty exclusion for people who sell their homes. It's been 500,000 excluded from capital gains for if you're married. So what does that mean? Let's say you bought your house for 300,000 and you sell it today for 800,000. You don't get taxed on that 500,000. At least that's my layman novice understanding of it. And when Doug comes on, he'll correct me if I'm wrong. But now, with the market so hot, I think, Bruce, we're seeing people who bought their house 30 years ago, they're realizing more than $500,000. And
Yes.
so if there's any kind of calculation or way to mitigate additional capital gains, that's what Doug's going to talk to us about. And he'll go over all of that and all that kind of stuff. So how was your day, Bruce?
It was busy. I started with a walkthrough at 8 o'clock this morning. So those are always fun. Walkthroughs.
That's where you went. It's funny. Are you sure? I thought you were golfing. You sure you weren't golfing this morning?
That I'd have preferred that, frankly, but I didn't. And now it's going to rain tomorrow. I wish that tomorrow I did the walkthrough.
Bruce likes to say he's on a walkthrough.
Yeah. But walkthroughs are always interesting. We talked about this last week. You just never know what surprises you're going to find. And I'd say that these people that were selling did a pretty good job, but there were things left behind that I had to clean out, and it's part of our job. It's what we do.
So remind everybody what a walkthrough is, because we use the term all day long.
So a walkthrough is the final time that you visually inspect the home before you take ownership. So in the process, if you have an inspection by a professional inspector, they tell you all about the things that are, that may need addressing. And sometimes you are going to negotiate some repairs that need to be done to the home before you take ownership. So today, for instance, there were 3 or 4 repairs that needed to be done to this home. There happened to be a bee's nest in the attic that needed to be removed. So we had to inspect that some of the repairs were done correctly. We're also making sure that the home is in the same shape we expect it to be in based upon the inspection. So if at the inspection we turned on the water, we turned on the heat, we want to make sure they still all work. But sometimes people forget things. So in some of the cubbies and closets, there were just like leftover weight plates. A 45-pound weight plate was left over. There was some cement blocks that were out in the yard. Just nuisance things that we had to do.
I'm sure the sellers thought those cement blocks would be useful to your buyers.
Yeah, that's always one of my favorite things, that we left things that we thought they could use when it's not always the case.
All right. Well, listen, I think it's time. We're going to bring on our expert who everyone's been waiting for. So let's bring Doug onto the stage, and we'll get introductions out of the way, and we can get all our questions started. And I see some questions being posted, so we'll get those answered as well. And here we go. And there he is.
Whoa.
Handsome guy. Look at that.
Thank you so much. Thank you, Diane and Bruce, for inviting me. It's really been great working with you both for a few years now. And I'm sorry I didn't end up golfing, but you know what, Bruce? Tomorrow's another day, and just like Caddyshack, I think the heavy stuff's going to hold off for a little while.
Well, I was going to say, the funny thing, Doug, I was looking at the tee sheet just like an hour ago, thinking I probably could squeeze in 9 holes at 7:30 tomorrow morning, and there was nobody playing tomorrow morning. And then I looked at my weather report and realized why. So you think it's not going to get heavy yet? I might play.
I think you can make it happen, man. It can't hurt. I'll put it that way right there. It could be a good thing. So I'm sure.
Diane, I have a walkthrough.
Yeah. I've heard that before. I know
Yeah,
it's really a little ridiculous. But
it
whatever.
is. So, yeah, thank you so much for inviting me. I'm really excited to talk to everyone and really get into a super fun topic that everyone is loving to talk about, which is taxes. So, one of the big things that Diane really hit the head on is it's a crazy hot real estate market right now, which is fantastic because Diane and Bruce do such a nice job to represent their clients. I'm one of their clients, and I'm really fortunate to have such skilled expertise helping my family and I and all of my clients and colleagues' needs right there. So one of the things Diane said, which has been very relevant, is this past year is crazy to have such a hot seller's market right there. And what most people think is great, I'm going to be getting a killer score when Diane and Bruce work their magic and help us negotiate a fantastic sale. Sometimes the things they don't always think about is when I give them a call in April and it's time for taxes. And they're like, what do you mean there's taxes? And they have a thing that Diane referenced, which is super important to homeowners who own their primary residence. They basically have a rule that says if you live in your primary residence 2 out of 5 years, doesn't have to be back to back, doesn't have to be consecutive, 2 out of 5 years, you can either exclude, if you're single, $250,000, or if you're married, $500,000. So Diane gave a fantastic example earlier where our hypothetical client had a $500,000 gain. And in this example, if the seller hasn't used their exclusion in the past 2 years and can meet the requirements, there's no tax and drinks on them. And that's a great thing for me to tell them that I don't need any tax money. And that makes them really happy to have all this excess income.
That's awesome. Now, what if it is more?
What if it's more? Great question. So basically, let's say Diane and Bruce really knock it out of the park and we get, let's use our hypothetical person, and they get us $1 million and they do such a nice job and we're doing backflips and we're super excited. Now our gain in this example is $700,000. So what would happen is the $500,000 would be excluded. And then what would happen, the remaining $200,000 would be taxed at capital gains rates. And depending on that person's income, all in Fed and Massachusetts for intensive purposes, let's call that 20 to 25 cents on the dollar. So in an example right there, 200,000 times 0.25, that means I would be saying I need $50,000 in taxes by the time we file our taxes. The things that we could do to maybe mitigate that are a few things. The first thing is we get to deduct a variety of different expenses to try to identify what our profit is. The first thing is the closing costs. So typically when there's a sale, there are closing costs. They have to pay the fabulous Diane and Bruce their broker fee right there, or the other party right there. Oftentimes there might be maybe a credit to one side or the other. That often happens. Sometimes there are stamps and deeds and various like miscellaneous costs associated with it that we get to deduct from our sales price. That's commonly referred to as our adjusted sales price. So as an example, let's say our closing costs were $50,000. That just means I've reduced my gain from $200,000 taxable to $150,000 taxable. The next really important thing is since day one, when we stepped foot into our primary residence, we really need to do a good job identifying the major improvements and renovations we've done to the house. So since the cumulative ownership from day one till the day we sell, we get to deduct our major renovations. I'm talking like big dollar items like roofs, renovations to bathroom, kitchen, big dollar amounts. And those can be used to deduct the gain to lessen it even more. So at the end of the day, the whole goal would be take my sales price, deduct the various closing costs, deduct the various large improvements. We're not talking dink and dunk little things like a light bulb. We're talking major renovations. And that amount leads to a profit or loss. If that profit is greater than $500,000, then whatever that difference is, we would pay 20 to 25 cents on the dollar. So those are the big ways to identify how we can exclude our gains when it's tax time in April.
That's excellent. I particularly like the renovation part of that. So if we've owned our home for 10, 20 years and it's increasing, but we've been renovating a bathroom, a roof, we add a deck, we do a whatever, it changes the value and the basis of what our cost was originally.
Yep, you nailed it. It increased our cost basis. That's our like geeky accounting term that we're going to use when I ask you what's your cost basis when we do our taxes. So that increases our cost basis right there. So that's a super important thing to hopefully mitigate taxes on the sale of a primary residence.
And is this a capital gains tax is something that is paid one time after the sale in that tax year? It's not something that's done over time.
Yep, correct. This is a one-off right there. So what happens is we sell our house, Diane and Bruce nail it and get us a killer sales price, and we have to pay tax right there, which stinks. We will have to pay it for that tax year only. So it's a one-time off right there. And basically there's two determining factors. When do I actually have to lay out the money to the government? There are two methods to understand. The first is there is this thing called safe harbor, which basically means as long as I pay 100 to 110% of the gross tax in the calendar year, we don't have to pay the balance of our taxes. We don't have to give the government an interest-free loan. So the remainder of the taxes that would be owed above our safe harbor that we've paid in, we could just pay April 15th. No big deal right there. So most people will meet their safe harbor by just their withholdings, maybe on their W-2s for the prior year or any quarterly estimates. So basically April 15th, assuming they don't change the deadline like they've done the last 2 years, then we would just have to stroke a check to the government right there. And we're paid up. That's post-tax money. You guys can do whatever you want.
So one other thing I got out of your explanation, Doug, which now Diane and I have to talk about as a business strategy. So when somebody sells their house and they pay Diane a commission to sell the house, that's deductible off of the cost basis of the house.
Correct. So on the CD or the HUD-1, at the end of the day, when they're about to have the closing, the buyer and the seller get a HUD-1, which is now commonly referred to as a CD, a closing disclosure. And it spells out, here's all the income, here are all the various deductions. This is where the money went. This is what we paid off. This is the money in our pocket. And those key forms will spell out the various deductions we can use to identify our cost basis.
So if there is a sizable capital gain, maybe they'd like to pay Diane a larger fee to sell the house and not pay it to the government. Just a thought.
I think that's a fantastic idea, and I fully support it, because knowing Diane and you probably got them so much more money than they were anticipating that they would be happy to reciprocate and not pay any taxes right there.
I love it. I think that's a business plan.
I like it a lot too.
Yeah. So even in so those things, we have a process in our business each year. Come January, we do send out an electronic copy. We used to do it snail mail actually, but we do gather up and send out electronically everyone's, as you said, HUD-1 settlement statements to all of those sellers that closed in the prior year. So they do have it handy, and they can hand it to their accountant when the accountant says, oh, you sold your house in 2021? Where's your HUD-1 settlement statement? And they go, I don't know. And then the attorneys start getting emails, and the attorneys at whatever. So we try to make it easy and send them that settlement statement so they do have it in time for tax time. And let me ask you another question. On the buy side, if someone's buying a house, is there anything deductible for a buyer? In that case, I just figured I'd ask.
So on the buyer side, one, we have the closing costs that they pay. So there's closing costs on the buy and the sell side. That leads to increase their adjusted basis right there. So they'll get that, which will increase it. They'll have the various closing costs. Typically, when you buy a property, they make you pay the real estate taxes a quarter ahead of time. So whoever is buying a property would want to provide the accountant or the CPA, the CD or the HUD-1, because they're going to show that, hey, you guys had to prepay real estate taxes at closing. So that way they get to deduct it as part of their itemized deduction, as well as any points or any prepaid mortgage interest. Those are kind of the key immediate bang for your buck deductions on the buy side. The rest of the items add up to their adjusted cost basis, which they will get down the line when they ultimately sell it as part of their adjusted cost basis, to answer your question.
So prepaid interest and real estate taxes paid on the settlement statement, paid at closing, are deductible for the buyer.
Yep. So the buyer could deduct on their tax return either A, the points they pay, if there are any points, the real estate taxes they prepay, less any credit that they get back from the seller if there's like a reconciliation, which often happens right there, and any prepaid mortgage interest that they have for like that period of time before the mortgage kicks in. Those are immediate deductions that they would get, not affiliated with their cost basis, that would be used to reduce their taxes on their tax return, hopefully if they're able to itemize right there.
That's fantastic. So let's go into another situation. Because the market is so strong, we have some clients who are also considering selling their investment properties. So in a case where I own my own single family home, personal residence, and I have an investment property, and I've owned it for 2 years, and I'm thinking of maybe taking advantage of this market. My tenants are kind of a pain in the butt. I didn't realize it was going to be kind of a pain in the neck being a landlord. It sounded good at the time, but now it's a little bit stressful. Can you talk to us on the differences, if any, when selling that investment property?
Sure. That's a great question right there. So the conversation we just had about a primary residence is an apple, and now selling an investment property, whether a flip or a rental or a second home, is an orange. And here's how it works in this situation. Let's assume we have a rental property, just for ease of a hypothetical conversation. So what happens with a rental property is we have the same format where we'll have a sales price, less our closing costs, less our cost basis, and then there's a gain or a loss. Then what typically happens with a rental property is the government lets you write off, as part of a rental expense, this thing called depreciation, which is basically an accounting term for wear and tear. It's a paper deduction where we get to write off part of a condo or a house at a certain allocation point over a long period of time. And we get upfront tax benefit each year to reduce our rental income. Whatever we cumulatively take for that depreciation that we got a tax benefit for, when we turn around and sell our rental property, we have to recapture, and that reduces our cost basis because we've already got a tax benefit. So what would happen is that gain, after all said and done, is subject to 2 types of taxes. If it's sold in under a year, which probably not many are if it's not a flip, you pay ordinary income tax rates for the Fed, and Mass is 12% right there. If it's over a year, we are going to pay the same long-term capital gains rates, which is anywhere from 20 to 25 cents on the dollar for the Fed, assuming the current tax laws. Let's control what we can control right now, and see what my Syracuse alumnus wants to do in a little while. And Mass is 5%, And whatever the depreciation we've taken, we typically have to recapture it, and that's at 25 cents on the dollar. So that is a taxable event, and there are a few things we could do to try and mitigate that. The first thing is, let's say that rental property once upon a time was your primary residence, and you lived in there 2 out of 5 years. You would still get that $250,000 or $500,000 exclusion if you can meet those guidelines, even if it's no longer your primary residence. As long as we're in our 2 out of 5 window, we can still exclude the gain. The only thing we would pay tax on is the depreciation. So that's a big avenue for a lot of people who buy condos or houses and their life changes and they want to move and they try to rent it out. This is something we did right there. This is a huge thing that can save a lot of money in taxes. Another really big thing is a thing called a 1031 like-kind exchange. This is a really big thing to consider if you're a real estate investor or a landlord and I don't want to pay taxes immediately. Typically on a transaction, there are 2 options. Option A, Diane sells the property, we pay the tax, you go on your way and have a nice life with the post-tax money. That's cool. Option B is you can do a thing called a 1031 like-kind exchange, which basically means in English, we are going to sell our investment property. We are going to buy 1 to 3 new investment properties. We have various timelines we have to meet. You have, I believe, 45 days to identify 1 to 3 properties you may want to buy, and you have 6 months to close on those properties. You must buy for $1 more than you sell, and you need a like-kind exchange agent. This is an intermediary that will physically be the middleman or woman and hold on to the money because they say you can't touch it. And if we accomplish all those things, we defer whatever that taxable gain is into the future. And that basically just lowers our cost basis and we kick the can way, way, way down the road. And that's a great thing because oftentimes if you sell an investment property, you will pay the capital gains tax, the mass tax, and depending on your income, they have this thing called a net investment tax, which means if you are a passive investor and your income, I believe, is over $250,000, you pay 3.9% on your passive activities, which includes the gain on the sale of the property. So really, those are big key elements that we need to identify if your goals are, I'm really not trying to pay taxes, I want to build up a real estate empire, I want to use this and compound it. Those are great strategies that we work with clients to really identify, as well as like, what is our timing aspects? Maybe some people really need the cash and they identify like, we're at a bracket, this isn't going to jump me or anything. So there's a lot of different moving parts to really think about, but there are solutions to that side of the coin, Diane.
That's awesome, Doug. That is like such great information. I know that I've been involved in a few 1031 exchanges in our business while we deal with mostly residential property and primary homeowners. The situations that we've run across are where clients of ours may own an investment property in another state, and now they're here and they really like to own something closer so that they can manage it better. Sometimes it's just difficult to manage a property from afar and they'd like to exchange it for something closer that they'll have more control over. So we've seen it in that case. The other place we've seen it are where clients are inheriting property, right? And same kind of thing, you know, their parents might be in New York or another state or Florida. They inherit a medical building or whatever it might be, and they don't really want to run a medical building in New York. They may be in Mass, and instead of selling it and realizing that gain, or I'm sorry, if they inherited it, it's worth a lot of money, right? So,
well, I'm really glad you brought that up because that's an actually really intriguing concept, Diane, that a lot of people do run into is inheriting property. So one thing to really think about, and this is a great thing, and we're going to cross our fingers this doesn't go bye-bye if my alumnus president has his way.
And don't let me forget, before we get off, we need to talk about your alumnus president and what's in the pipeline. I want people to know that's lurking. So if there are changes, I definitely.
Yeah, there's a lot of things. So really quick, this is a huge thing. And this is probably, I'm really glad you brought this up because this was something I was going to conclude with. They have a thing, if you inherit a property, that's called a step up in basis. What does that mean? Let's say I have a family member and they bought a rental property back a long time ago for $100,000. Let's say they passed away yesterday and the fair market value of that property was $500,000. Whoever inherits this property gets a step up in basis, which means their new cost basis is not $100,000. It's $500,000. So what happens is if you inherit a property that's not through a gift, meaning someone passes away and leaves you an inheritance through their will or probate, my new cost basis is $500,000. So if Diane and Bruce sell that property for $500,000, I'm going to pay zero in taxes right there. And that's a huge, huge factor for men and women who are really inheriting anything from an older generation. That can make a world of difference for taxes. And that's now going to translate to Diane's question, looking at my Syracuse alumnus and shaking up his crystal ball and seeing what's going to happen. Because there's a lot of moving parts right now that aren't finalized. Right now, President Biden has gone out and said, I want to make some major tax changes right there. What are some of those tax changes right there? Well, if he has his way, that step up in basis would go bye-bye. One of the things he's talked about is disallowing it right there. So that's a key thing for people to monitor, because if that happens, that's going to lead to a ton of income taxes for either the person who passed away as part of an estate tax or the person who inherits it and not getting a step up in basis. One of the things we talked about was a 1031 like-kind exchange. Right now, there's no cap on how much you could defer. Right now, one of the things in the pipeline is the most you could defer is either $500,000 if you're single or $1 million if you're married. And it's unclear if you can do more than one like-kind exchange in a year. That's kind of up in the air right now. So that's a really scary thing to think about right there. Another thing he's talking about is long-term capital gains rates. I'm sorry, were you breaking up? I think we're breaking up. Can everyone, Diane and Bruce, can you hear me okay?
I'm back. I can hear you.
Bruce, I can hear you. Diane, can you hear me okay?
Get Diane.
You're a little frozen right now. Not sure if you can hear me. I can see and hear Bruce. Diane, it looks like you might be frozen.
Yeah, I think Diane's frozen right now.
Okay, I can keep going if everyone can hear me.
Go ahead.
Okay, I can hear you now, Diane. It looks like we're back in business.
You're good.
So one of the things that he had talked about in his presidency was raising capital gains rates. So one of the things he's talked about is if you have over $1 million of income, long-term capital gains rates would jump from 20 to 15 to 20% to up to the highest rate, which would be 40%. So what could happen would be, let's say the most you would pay under current law was Fed 20%, Mass 5%, net investment tax 3.9%. Let's call that 30 cents on the dollar for a simple round number right there. That would mean that we're going from 30% to 50%. And that would be killer. That would crush a lot of people. Now, what has happened is right now they are putting together a draft bill that they're trying to move forward. And from what I've seen, they're trying to mitigate and have the long-term cap gains rates capped at 25% for the Fed. So right now, this is something I've been talking to people about all year. There are things we can control, and there are things we cannot control right there. And there's a lot of things that we are going to see shake out that's going to make a world of difference right now. I would still say this: real money trumps tax money every day of the week. If Bruce and Diane can make you a killing, I would not be thinking about calling your CPA and crying about like owing taxes. Those are good problems to have. That means we're making a lot of money. There are a lot of different strategies we can do to mitigate the tax, and there are a lot of things that we're going to have to continue to monitor. And that's kind of the upshot right now, and it's kind of wait and see for my fellow Syracuse alumnus.
I'm going to ask you one more question, and this came up actually with a colleague of mine who is in Connecticut, who is deciding to buy. Oh, Bruce is leaving us. All right, I'm going to finish up with one more question. Bruce,
I'm not golfing though.
All right.
Well, make sure you invite me again. I would love to play again.
Doug, you are awesome. Thank you.
Can I tell people where you're headed?
Go ahead.
His day job never stops. So Bruce has the somewhat, all right, I won't say it's thankless. He does find a lot of rewarding times out of it. For the past how many years? He's been involved in the Sharon Travel Basketball Association. And tonight is the board meeting where they put together all the travel teams for the entire Sharon Travel Basketball grades 4 through 8.
Good for you. That's such a great thing.
Yeah. So we've got a lot of work to do. I've got to get to a meeting. Doug, this was awesome.
Thank you so much. I'm so glad I could be here to support everybody and give great insight. And
this was awesome.
Look forward to catching up.
I think I'm going to end it here too, because there was not a lot more that this was like great information. We covered so much. And if people have more questions that we haven't answered tonight, you can post them in the comments and we'll get them. And you can reach out to Doug. Doug, if you have questions and, shout out, how can people reach you?
Yeah, thank you so much, Diane. So I will put all my information in the comment bar so people can reach out to me. I own a CPA firm in Easton and Dennis called Koval Anderson Koval. We do a lot of different things. We prepare over 700 individual tax returns. We do over 400 entity tax returns. We file tax returns in every state. We work with clients in a variety of different situations, and we want to be more than a bean counter. I want to be an advisor. I want to be talking to you during the year so we can make an impact on these goals. You can reach out to me at my email. It's doug@kovalandersonkoval.com. Our office number is 508-238-7020. And if they want to check out our website, it's kovalandersonkoval.com. And I'd be happy to chat with anybody if they have questions and try to help them out as much as I can.
That's awesome. I hope everyone, thank you, Doug, so much. I hope you all got great value out of tonight. And thanks for joining us. We'll see you again next Thursday. So bye, everyone.
Everybody.